All right, everybody, I'm going to be digging into BlackRock's earnings in this video. It's a little slower on the Canadian market, so I figured I would dive into a US company and a company that is actually one of my largest US holdings. I really like this company. I don't foresee myself selling it at any point over the next while, and there's actually a big tailwind going on right now with BlackRock because of, well, it's a wide variety of things. First off, the equity markets, the stock markets are absolutely booming. Inflows pretty much across the board from retail investors, institutional investors, and the vast majority of BlackRock's revenue and profits are going to come from fees, going to come from new ETFs developed, new inflows, things like that. And so the active equity markets have become a big tailwind for this company after a pretty slow 2022 where assets kind of dipped because of that bear market, because ultimately, as I mentioned, BlackRock generates a ton of money from fees. So as assets under management go down, ultimately fees are typically a percent of AUM. So that impacted their revenue over that time period. But it ended up being a great time to accumulate this company because it's doing very well as of late. So everybody, if you appreciate the content I'm delivering, you can join around 25,000 other Canadians who are getting weekly market insights, commentary, case studies, things like that. And I'll also throw in a report on 3 of my favorite options in 2025. But let's dive right into the quarter. So BlackRock closed out 2024, I believe it was last week, and the company actually reported some very strong quarterly results. So if we actually go to estimates here and we go to quarterly, we can see that the company actually topped earnings expectations by around 6.36% and revenue by around 1.73. So we're talking about earnings of $11.93 versus expectations of $11.22. And one of the main reasons for this was extensive inflows into the company. So if we come back to the quarter here, these are the net flows. So this is going to be the total inflows of BlackRock. It's going to count their ETFs. It's going to count institutions, retail investors. Let's think fixed income. We can think alternative assets like private equity, things like that. So we can see total inflows of $281 billion. And the crazy thing here is analysts had expected around, I believe it was around $198 billion. So this company blew through those inflow expectations. And I mean, the markets are really strong right now, and there's a strong shift from not only retail investors, but institutional investors to take advantage of exchange traded funds. So that's going to be something I talk about a little bit later here. But if we come down here quickly to the ETF section, we can see inflows of $143 billion. So they made up more than half of the total inflows of the company in the fourth quarter of 2024. So when we look to the overall trend of inflows, we can kind of see how cyclical this company is, but not really from the aspect that it's cyclical based on the economy. I mean, if I were to name one stock, let's say CN Rail, which is going to be cyclical based on just overall, economic output, what they're shipping, the demand for oil, the demand for a multitude of commodities. BlackRock is going to be cyclical in another way, and that is market activity. And we can definitely see this occurring. I'm actually going to go to FinChat here because BlackRock only has from Q4 2022, and I'm going to select all these inflows here, and I'm going to give you an idea how the markets actually dictate the overall flows for BlackRock. We can see a huge benefit here during the COVID-19 pandemic. We're looking at 1.887 in inflows here to 3.479. So you're talking about nearly double the inflows over that market run up in activity. However, when the company started, when the bear market hit, when interest rates started rising, we can see a lot of decline in flows as less people were investing, less institutions were investing. They were maybe pulling money out because of the bear market. But then we can see as the markets return to popularity, we can see a big jump in total inflows. So this company is going to be something that really fluctuates in terms of the popularity of the market, but it has been pretty much a long-term provider of, arguably market-beating returns. If we come back here and we look to the 5-year return chart, we're looking at around a 15% beat in terms of the S&P 500. Now, when we span this out to shorter time horizons, we can see, it's trailing by a bit, but it really struggled here during that bear market, which completely makes sense. This is something that if you were debating owning BlackRock, you really need to come to terms with. This company is going to do well as the markets do well, and when the markets inevitably don't do that well, the company is going to struggle. And for me, this just pretty much creates an opportunity to accumulate shares on the cheap. I mean, I was buying here. Am I buying here? I'll go over that in a bit. But overall, cyclical based on market activity. When we looked at 10-year returns, 259% versus 253, pretty much matching the index, a slight beat. But again, I'm going to highlight here 2018. What happened in 2018? Well, we had a bit of a rate cycle. Rates started increasing, flow started decreasing, and we saw a big drawdown in activity. So if you're going to be buying this company, you need to understand that cyclical nature of it. But I want to get back to the earnings here. So we're looking at, heavy inflows in terms of market popularity. And if we head down to the profitability of the company, we can see a big expansion in terms of operating margins as well. If we look to Q4 2023, we're looking at operating margins of 41.6%. That has jumped up to 45.5%. So even if we look back to 2022, operating margins came in at around 41.2%. So we're seeing a consistent rise in operating margins, and a 45% operating margin is a very, very strong operating margin. So what operating margins effectively are, they will be, so like we have gross margin, which is revenue minus your cost of goods sold, whatever it costs you to produce that revenue. And then with operating margins, we have things like selling, SG&A expenses. We have other operating costs like research and development, maintenance costs, things like that. Operating margins are a very strong indicator. It's one of the closest margins that I follow, and a 45.5% operating margin is outstanding. And as a result, we see here a big increase in earnings per share. Obviously, we're seeing a decline again during that, kind of flattish market period, but now we're seeing a big boost in earnings per share because of that run up. Now, when we look to the company's dividend and shares outstanding, we can see pretty much a consistent decline in shares outstanding. BlackRock has been known to be a pretty consistent buyer of shares, and it's also been known to raise the dividend at a pretty consistent pace. Now, one of the reasons why shares outstanding have gone up recently, we can see here they include 6.9 million shares issued as part of consideration for the acquisition of Global Infrastructure Management. So this is pretty much a infrastructure management company that BlackRock acquired. They kind of operate, they have assets in energy, transportation, water, waste management, digital infrastructure, things like that. So BlackRock had kind of acquired this company to pretty much diversify its asset base. So we have a little bit of a share issuance here. I would expect the company to continue to buy back shares as we move forward here, but it does make a lot of timely acquisitions. A lot of people believe that this company needs to grow solely through acquisitions because it's just so large. But when we we come up here and look back to organic growth rate, we can still see that the company is growing around 6% organically. So it still does have that internal growth. Now, is this as strong of an organic growth rate as it used to report? No, that it is true that once a company gets to as large of a scale as BlackRock does, it is difficult to grow organically. So it does have to do a lot of it through acquisition. And obviously we see, it made a recent acquisition, and it's going to continue to acquire companies moving forward. But overall, the company still does have room to grow internally, and I'll get to that in a bit when I discuss the ETFs. But when we go to the quarterly revenue, we can see that the vast majority, 74% of revenue, comes from base fees. These are, fees that come from, say, charges for managing client assets, equity, fixed income, multi-asset, alternative assets. They can come from administration fees that are provided to clients, so record keeping, operational support, things like that. And when we look to ETFs, that drives a ton of the fees as well. And iShares, I imagine you've heard of it. It's one of the most popular ETF suites on the planet. I mean, they run a very, very solid operation. When we go down to full year revenue, we can see base fees around 76%. So base fees in general account for the lion's share of BlackRock's revenue. So it's safe to say, as the equity markets get more popular, the fees BlackRock collects are going to grow. I want to highlight to you the iShares ETF inflows. We can look at the inflows to iShares ETFs. We can look down here. It's growing since 2019 at a compound annual growth rate of 13.5%. We can see a big run up during the pandemic. We can see a fall down and then a big run up again. Now, this, I believe, in my opinion, is going to get more and more popular as not only more retail investors shift to an ETF strategy, whether that be passive or active, but institutions as well. There's a lot more institutional clients buying exchange-traded funds, and ultimately, these ETFs are one of the main ways that BlackRock drives revenue, and they are very, very good at what they do. We can look to IBIT, which is the cryptocurrency ETF they launched in the US last year. That was, I don't actually know the exact numbers, but I know for a fact that it was either one of the strongest ETF launches in history, or it was the strongest launch in ETF history from a collection of assets under management standpoint. And what did they do like a year later? Just recently, they announced that they are bringing IBIT to Canada. And instantly they came into Canada with that fund, the lowest fees possible. And other fund managers like Fidelity, they actually had to come in and lower their fees almost instantly because of BlackRock entering the market. So I think this is ultimately beneficial for retail investors. There's going to be a fee battle here where, fees are just going to get lower as the competition rises. And because BlackRock is in such a strong situation from an assets under management standpoint, ultimately, the more assets under management you have, typically the lower the fees you can charge and, still remain profitable. That's why you see a lot of these startup funds in Canada that have very low assets under management, they have to charge high fees. And as the AUM grows, the fees generally come down. This is typically how it works, but BlackRock is in a position where they have such a dominant share of the market that it's going to be able to continue to benefit from that, competitive advantage and release more funds. And when we come down to the actual revenue base of the company, I'll add all the types of different revenues here. And if we go to a stacked bar chart here, you're going to get a bit of an idea as to how much ETFs matter for BlackRock. We look to the stacked bar chart for total revenue, and we can see the blue would be the ETFs. It is the largest chunk here. It's not the fastest growing, actually. If we come down here and look at their overall revenue makeup, we can see that performance fee revenue and cash management revenue are actually growing at a heavier compound rate. But when we look to the purple and the green here, they're very, very small portions of the business relative to ETFs. ETFs growing at a near 9% compound annual growth rate is going to provide much better results than these smaller segments growing at a double-digit compound annual growth rate, but they're still important aspects of the business overall. But ETFs is one of the main theses for me to own BlackRock. I think iShares is just absolutely crushing it, and they're going to continue crushing it in the future. Now, the final thing I want to go over is obviously the valuation and whether I'm adding at these prices. And the one thing I'm going to do is actually use our Stocktrades stock screener over at Stocktrades Premium, because it kind of highlights kind of gives you a bird's eye view much easier than the data that I use from Y-charts. It's, there's not as much, data on the surface that you can see and kind of compare back and forth. Whereas I constructed this screener to kind of give our members a way to kind of look at valuation, a whole multitude of things: profitability, risk, estimates, dividends, analyst estimates, debt structures, valuations, things like that. Much easier and kind of all in one place. So we look to a current price of $1,005. We're looking at a 1-year price target of $1,163. This would be analysts' 12 to 18 month price target for the company. They're not our price targets, but it does show, 15% upside in terms of what analysts are thinking. When we look to valuation, we're seeing an earnings yield of 4.2%, which, you could typically chase a higher earnings yield than this, but it is pretty attractive, especially considering the run that BlackRock's been on in terms of, over the last year. But when we look to actual valuations, we are seeing the company trading above historical averages. So we're looking at a price to earnings of effectively 24x versus a historical ratio of around 20.8. So the company is trading at a double-digit premium to what it typically has over the last 5 years. But the one thing I do want to note is this 5-year historical average would have had that 2022 bear market where the company did trade at relatively, attractive valuations. It was below this. When we look to a forward earnings basis, 21.2, this is typically going to be, this is not a crazy valuation for a company that is growing at the pace they are, has the economic moat they do, has the, operating margins, pretty close to 50%, 45-ish% operating margins. We look to a PG of 1.6. This kind of indicates that, a lot of the growth for BlackRock is currently priced into the stock, but I mean, this is just a single valuation ratio. I wouldn't, get too hung up about this. We look to price to book trading above historical averages, 3.8 versus 2.9, EV/EBITDA 16.6 versus 14.9. So the one thing is, all things kind of point to BlackRock being a little bit expensive here. And when we look to the actual profitability metrics, we're looking at 14.5% return on equity. It's above historical averages. We're looking at a 12.2% return on invested capital, again, above historical averages. We're looking at gross margins kind of hovering in line with averages. Operating margins, YChart seems to be reporting a much lower number, which is probably because BlackRock adjusts some things out in terms of their operating margins. And when we look to a bottom line profit ratio, it's actually trending above historical averages. So the thing is, BlackRock is expensive here, but it's also doing a lot of things right, which is probably the reason why the market is valuing it a little bit higher right now. Would I be a buyer at these levels? I actually ended up trimming a bit of my position on this run up. That really wasn't anything to do with BlackRock. I actually ended up trimming my Canadian banks and BlackRock. My financials had a gigantic run up over the last year or so, so I was heavily allocated to financials, so I did end up trimming that position. But ultimately, I don't think I would be too upset buying this company at this price level. I mean, if the markets do take a bit of a dip, we're probably going to see a dip in BlackRock's price, but nobody had an idea of what the markets would do in 2024. We have no idea what they're going to do in 2025. Could there possibly be a better time to buy BlackRock? I mean, I guess one could say yes, but you probably could have said so back, in 2010. It's only been a 4x from there. So, I mean, it's really hard to time these, companies. I generally have the mentality that, you just buy strong companies, hold them for the long term, kind of, weather out these cyclical ebbs and flows. If the company does dip again, if we have another event like 2021, where it led into a significant decline in price for the better part of a year and a half, I'll just continue to add at these points. I mean, BlackRock is a high quality company. 11.5 trillion in assets under management right now, a strong dividend, strong buybacks, very strong total returns over the last while, a market beater over the last 5 years, 10 years, pretty close, market matching return over the last 3 years. And it's just going to be a company that I continue to add to my portfolio over the long term. And my trimming recently was solely due to an asset allocation perspective. So everybody, hope you liked the video. Head down below, like the video, subscribe to the channel, comment, let me know if you own BlackRock, what you're buying right now, especially like what videos you want to see. I will do any video anybody asks for, but you got to drop it down in the comments, because if you don't, I don't know what you want. And we'll see you next time for more great Canadian content.